In today's video, I'm going to walk you through some of the most common 401k withdrawal mistakes I see retirees make and how these missteps can undermine even well-built retirement plans. If you're new to the channel, hi, I'm Julia, certified financial planner and managing director of URS Advisory. And after analyzing the withdrawal patterns of hundreds of retirees, it's clear that decisions like tapping accounts too early, triggering unnecessary taxes, falling victim to the widow's penalty, and more, often leaving people to work longer than they intended. And that's why I'm making this video, to break down how 401k and IRA withdrawals really work, highlight the key mistakes to avoid, and share more thoughtful strategies that can help you preserve your savings and retire with confidence. So let's get into it. First, let's discuss the early withdrawal penalty and why taking money from your 401k early can really set you back. When Eric and I taught our retirement planning courses at local community colleges, we'd meet with some folks that had to pull from their 401ks for different reasons, illness, family issues, etc. And they just didn't realize the damage they'd done. They had basically forced themselves into working into their 70s to have any shot at retirement. A lot of people know there's a 10% penalty for taking money out of a 401k before age 59 and a half. But what they often miss is that's just the penalty, right? It's one piece of the cost. When you pull money out early, it's also taxed as ordinary income. That means that the withdrawal can bump you into a higher tax bracket, and especially if you're still working, right? You tend to be in those in higher brackets. So between taxes and the 10% penalty, you could end up losing 40%, right? Just right off the bat from drawing from it. And besides this immediate tax hit, early withdrawals eliminate the potential for decades of compound growth. For example, withdrawing $50,000 in your early 50s could mean giving up over $200,000 in future retirement value, depending on how long that money would have stayed invested. The bottom line is that withdrawing early from a 401k should be viewed as a last resort. The long-term consequences often far outweigh the short-term benefit, and the financial setback can be very difficult to recover from. Next, let's talk about how traditional 401k and IRA withdrawals work in real life. Now, while you're saving for retirement and getting to deduct your contributions, life is pretty great, right? You're making good money and you're saving as much as possible, in a tax-efficient manner. But now let's talk about retirement, right? So you're not working anymore, you're no longer pulling in that paycheck, and now we're relying on this giant, pre-tax nest egg. Every dollar that you pull from that nest egg is going to be taxed as ordinary income, okay? And in retirement, there are other taxes or surcharges, right? Medicare IRMA, if your income is over a certain limit. There's also net investment income tax. That's not a retirement tax, but it's still, a tax. Alternative minimum tax, all sorts of sort of what I like to call hidden taxes once you retire. So if your only place to pull from or your primary place to pull from is pre-tax, then you're going to be seeing a lot of taxes and hidden taxes in retirement, throughout your life expectancy. Now, when we look at history, we can see that currently we're in a very low tax regime. This lends itself to the argument that we should be taking advantage of these low marginal rates and either contribute or convert a portion or all of our retirement or savings into Roth accounts to enjoy tax-free growth and income in the future. If tax rates rise, which we believe they inevitably will, your pre-tax funds will be worth even less than they are now. So for example, if you expect your effective or average tax rate in retirement to be 18% and you have $2 million in a traditional IRA, how much of that traditional IRA do you own? Roughly $1.7 million. If tax rates rise and now your average retirement tax rate is 22%, you only own roughly $1.6 million. And guys, I know that our tax system is progressive and that it's not exactly, 22% or 18% average, but just stay with me for the purposes of this example. Whereas if you had $2 million in a Roth IRA, you would own all $2 million in any future growth on those funds. Besides that, whatever your income gap is, right, the difference between what you're pulling in income and what you're spending every month, if you're pulling that from a Roth IRA, that income is also invisible on your tax return. So you might not even see taxes at all, right, if the primary account is a Roth. And you certainly won't see any of those hidden taxes that can compound over time. For instance, Bill and Jean pull in $60,000 per year in combined Social Security benefits. They need $140,000 per year to maintain their lifestyle, so their income gap is $80,000. Besides a small savings account of $30,000, their only other asset is a traditional IRA worth $1.5 million. If they need $80,000, right, that's a net figure. So they'll actually need to pull $91,000 out of their traditional IRA to get that net $80,000 that they need. This pushes them into the 22% tax bracket and means they'll owe $12,466 in federal tax. If they had instead saved in a Roth 401k or IRA, they'd pay $0 in federal tax, okay, with an income of $140,000. And this is not just 1 year, right? Push this out for your entire life expectancy, and we're talking about hundreds of thousands of dollars in federal tax. Please be aware of this as you approach retirement. What you think you'll need each month or each year will require a larger gross withdrawal, which can potentially push you into higher tax brackets, IRMA brackets, etc., depending on your situation. So even if you have other sources of income where you don't need to touch your pre-tax account, the government will start forcing you at either 73 or 75, depending on your year of birth, in the form of required minimum distributions. These withdrawals are mandatory and fully taxable as ordinary income. RMDs are based on your account balance and life expectancy, and the percentage you must withdraw increases each year as you age. That means the longer you live, the more you're forced to take out and the higher your taxable income becomes. One major challenge is that RMDs must be taken regardless of market conditions. So if the market is down, you're still required to withdraw, which could mean selling investments at a loss, locking in loss instead of allowing time for recovery. And because RMDs are non-negotiable, they take away from your control when it comes to how and when you pay your taxes. Even if you've carefully built a strategy to minimize taxes or preserve funds for later in retirement or for heirs, RMDs can override that plan, pushing you into higher tax brackets, affecting Medicare premiums, and reducing long-term compounding. Let's look at an example. Meet Susan Miller, a 73-year-old retiree with $1.2 million in a traditional 401k. She lives comfortably on $40,000 of combined Social Security and taxable investment income, and until now, she hasn't needed to touch her 401k. But once she turns 73, the IRS requires her to begin taking required minimum distributions. And based on the IRS divisor for age 73, her first RMD comes out to $45,283. That pushes her total income for the year to over $85,000, all of which is taxable. But what really catches her off guard is how this affects her Medicare premiums. Because RMDs count toward modified adjusted gross income, Susan's modified adjusted gross income rises to $108,000 after factoring in some of her tax-exempt interest income and capital gains from a mutual fund distribution. Crossing the $106,000 IRMA threshold for single filers in 2025, Susan is now subject to higher Medicare Part D and Part D premiums in 2027, which is a permanent increase that she did not anticipate. And each year, RMDs increase as the IRS divisor shrinks. So again, even if her portfolio declines due to a market downturn, she is still required to withdraw a growing percentage, possibly selling when the market is low, right, at a loss. What's more, these taxable withdrawals stack on top of her other income, increasing her lifetime tax burden and reducing her control over when and how she pays taxes. With better planning, Susan could have reduced her future RMDs by converting a portion of her 401k to a Roth IRA during her low-income years between retirement and age 73, keeping her modified adjusted gross income below key thresholds and avoiding unnecessary Medicare surcharges and tax creep. But because she's waited, she's now locked into a withdrawal schedule that works on the IRS's timeline, not hers. The next issue with traditional 401k withdrawals has to do with the widow's tax penalty. This refers to when one spouse dies and the surviving spouse ends up paying more in taxes and Medicare premiums, even if their income doesn't change much. This is because the surviving spouse can no longer file taxes jointly. They now have to file as a single person, which means smaller tax brackets, a lower standard deduction, and lower income thresholds for Medicare surcharges. Let's look at Tom and Linda Bennett. They're both 72 and retired. Together, they receive $60,000 from Social Security, take $100,000 from their traditional IRA each year, and earn $10,000 from other investments. As a married couple, their $170,000 income keeps them in the 22% bracket, and they don't pay extra Medicare premiums because they stay under that joint IRMA threshold. But after Tom passes away, Linda's income doesn't change much, right? She still needs to withdraw $75,000 from the IRA. She gets $38,000 in survivor benefits from Social Security. And so she still is going to end up over that $106,000 limit for the IRMA. So she's actually going to go into a higher tax bracket and pay more for Medicare, even though she's actually earning less than she was when she was married. The last 401k withdrawal mistake is one that actually affects your heirs. You may not know this, but when a 401k owner dies, the way the plan is structured and whether the funds remain inside of the 401k or are rolled over can significantly impact what options are available to your beneficiaries. If the funds remain inside the employer's 401k plan, beneficiaries, especially non-spouse beneficiaries like adult children, may have fewer distribution choices. Some plans require the entire account to be paid out as a lump sum or within 5 years, even though the Secure Act allows for a 10-year withdrawal window when these funds are rolled into an inherited IRA. These accelerated payout requirements can force beneficiaries to take large taxable distributions in a shorter time frame, often pushing them into higher tax brackets and eliminating the potential for continued tax-deferred growth. Even spousal beneficiaries who typically have more flexibility may find that certain plan rules limit their ability to stretch distributions or delay withdrawals unless they roll the 401k into an IRA. And since 401k rules are plan-specific and not all employers have adopted updated provisions under the Secure Act, it's important to review how your plan handles death benefits. It's much easier to just roll the 401k into an IRA to avoid these legacy traps. So, what can you do to prepare yourself so that you avoid these missteps? First, have a clear withdrawal plan in place before you retire and review it each year. Next, keep a cash reserve so you're not forced to take early withdrawals and pay penalties. If you leave work before 59 and a half, know the special rules, like the rule of 55 for certain 401ks or 72T payments for IRAs. But remember, those withdrawals are still taxable. In the years between retiring and starting RMDs or Social Security, Medicare, look at doing, small Roth conversions to stay within certain thresholds to keep you in lower brackets and again, below those ACA subsidies or Medicare IRMAA subsidies, whatever applies to you at your age. Use qualified charitable distributions at age 70 and a half to lower your taxable income if you're giving to charity. Plan your Social Security so the higher earner delays if possible. This can help protect the surviving spouse from higher taxes and Medicare costs later. Make sure your beneficiary forms are up to date and understand your 401k death benefit rules. And consider rolling old plans into an IRA to give heirs more flexibility. Finally, set up tax withholding, rebalance your investments as you take withdrawals, and run what-if scenarios so that you stay in control, minimize taxes, and keep your retirement on track. Now that you understand how 401k withdrawals work and the potential mistakes that can reduce your savings or increase your tax bill, you can take steps to create a withdrawal plan that supports your long-term retirement goals. If you'd like more guidance, you can watch my free training linked in the description, where I walk through strategies to help you build a secure and sustainable retirement plan.